Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Kevin Davitt, head of index options content at Nasdaq, as well as Noel Smith, managing partner and chief investment officer of Convex Asset Management. We're here to discuss derivative strategies that include dispersion trading and how realized correlations impact the approach. It is great to have the both of you with us. Welcome to Trade Talks. Noel, let's kick it off with you. Your firm, Convex Asset Management, has managed money for institutions and high net worth individuals for years, and you've been active in a variety of derivative strategies, including dispersion trading. Now, realized correlations in the Nasdaq 100 and S&P 500 have moved to historically low levels. Explain to us how that impacts your approach.
So when the correlations come really low, which is to say the relative value of volatility within the index relative to the constituents of that same index, we typically will reduce risk when it's really low because we feel there's asymmetry to the other side. In other words, we don't think this is a good opportunity to add to our size or increase because if the market crashes at all and implied correlations get really big, which is to say the index moves more than the single names, then we just feel like it's a bad time to do that. So we just reduce our risk.
And Kevin, the Index Options Group has partnered with professors at Northwestern's Kellogg Business School to do research on using the Nasdaq 100 for dispersion strategies. Tell us more about that research and the approach.
Yeah, I'd love to. It's something I'm excited about generally. I think one of the benefits of being Chicago-based is proximity to a handful of really respected institutions of higher learning, and they have professors with deep interest in these markets. And I think it makes sense when you think about history too. Chicago's kind of always been the epicenter of derivative trading. And in that vein, it's no surprise that places like NYU or USC have great film schools. So I'm in Evanston and Northwestern is in my backyard, or maybe I'm in theirs, depending on your view. But I've come to know a couple professors, Torben Anderson and Victor Todorov, both of whom specialize in derivatives and volatility. And they're working with a postdoctoral fellow who is Amsterdam-based. Nasdaq commissioned them to do research on options data, like Noel mentioned, on the constituents of the Nasdaq 100, as well as at the index level itself. And the bigger picture, I think, which Noel would attest to, is that dispersion trading is expressing a relationship between that single stock vol and the index vol. The trade has grown significantly in recent years, and it's my belief that there is an opportunity for the institutional community to run these dispersion trading with NDX, with the Nasdaq 100 as the index leg. The default historically has been the S&P 500. Now, my belief there is not going to drive change in behavior. It needs to be bolstered by research. We expect that to come out at the end of this sort of 2025-2026 school year. That's going to fuel conversations and considerations on the part of groups like Convex to potentially allocate to these sorts of strategies.
Yeah, that's exciting. I'm looking forward to covering that with you. It's always great to get empirical research to support a lot of these approaches. Noel, like many others in capital markets, you have a background steeped in hard sciences and quantitative research. Convex offers a dynamic risk allocation analysis. Who does it? How does it work?
So kind of like what I was saying before, where we see an opportunity, the weather kind of changes in the markets, right? The opportunity set will change depending on a lot of the volatility that's in the marketplace. So what we've done is we've tried to distill a lot of really complicated ideas into their most functional components, which is to say risk on, middle risk, and risk off. So red light, yellow light, green light. And we try to take those risk regimes and apply them to all types of our strategies, which is to say, we don't think there's always a trade that always works, maybe other than high frequency trading. There are a time and a place to apply data so that you can optimize what else is going on. And that applies to dispersion trading, whether it be in the NDX or S&P 500, whatever. But I don't think anybody could say that it's always good to have that trade on relative to other times. There are good times and there are bad times. And what we're really trying to do is identify those times so that we can maximize our output for our investors.
Kevin, tomorrow's the last day of the third quarter of 2025, if we can believe that already. What are the highlights of late from the perspective of Nasdaq's index options business?
Sure. At I think the highest level. I'd argue that the Nasdaq 100 has been and continues to be sort of the belle of the ball. On a price level, the Nasdaq 100 is outpacing the S&Ps by about 350 basis points year to date. I believe this could be, like, if the year ended now, the 15th year out of the last 18 where the Nasdaq 100 outperforms on a price basis, looking at it in annualized. And it does so with a similar volatility profile. Now, the Nasdaq 100 index options component volumes have been booming. The backdrop over the past couple of months, which I would characterize as kind of relatively low realized volatility and kind of this tendency to grind higher, it has led to increases in short-dated spread trading. I've mentioned that on here before. Simply put, like, if you are likely to receive a slightly higher credit if you're looking to benefit from range-bound indices and options decay in NDX relative to similar moneyness spreads in the S&Ps because of that slightly higher vol profile. Giving the volumes a little bit more context, Q3 average daily volumes are on pace to be up 45% relative to the average for the first 6 months. We're seeing meaningful upticks month after month, particularly post-April, where equity swooned. And this growth is really going on its third year. My belief is that the marketplace is increasingly understanding the potential benefits of things like cash settlement and European-style products. Those are two elements of risk management that you don't have to worry about with an index product when compared to, perhaps a similar ETF or single stock option strategy. This month, one last point, this month, volumes are running over 100,000 per day. Now, on face, that's not going to get a headline in the Wall Street Journal tomorrow. But when you account for the size of the index, it's roughly 41 times the size of the Qs, then the volume number becomes more meaningful because it translates into roughly 4.1 million equivalent Q options. And that's a significant amount of risk that the market is managing through NDX, and it keeps growing. So we're very excited about that continued path.
And Noel, there's an ongoing boom in products that caters to the market's demand for income. They now come in a variety of forms, advisories, often the intermediaries, and you have an offering tailored to RIA and wealth management distribution. Can you explain to us how that works?
Yeah, and kind of to what Kevin was just saying, how the premiums in the NDX, you can get more out of them relative to the S&P 500. So we plan on using that as well. But what we've developed is we're taking an existing put spread writing program and we're applying some of our dynamic allocations to those put spreads so we can solve for what happens if the market gets really clobbered. So if the market goes down because of tariffs or because of COVID or something crazy like that, how can we avoid those steep drawdowns while also having the same reliable income stream for people that want those types of incomes? And so what we're doing is we're packaging those two main concepts, which is selling put spreads and our dynamic allocation model, so we can maximize the output.
And Kevin, you had a great, run this year with the team. Where will the efforts be focused into the end of 2025?
Like, the super short answer is we're going to keep on keeping on, but that's potentially a way to lose the long game. You had my colleague and friend Nick Smith on the program about a week ago, and he's been doing what I would consider really important work through the end of the year and beyond. So we're looking to facilitate more growth in longer dated, kind of structured NDX trading. That is institutionally focused business that often runs through like big buy side firms. So to that end, Nick is going to be at industry events talking to practitioners about their strategies. This week, he will be at the Global Volatility Summit, Jill, in your backyard in New York. And then he's headed to a handful of international events to meet with our clients. And ultimately, what we're looking to do is be responsive to all segments of the market, cultivate this super competitive, dynamic product that appeals to individual traders, to someone like Noel, who's running quantitatively driven approaches, vol-centric strategies, and to groups like the big banks that manage massive asset bases that increasingly correlate to the Nasdaq 100. So that's our focus, and that's what we're going to continue to rely on.
All right. We'll keep Nick busy. That's always a good sign. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.